that it's not just a matter of going back and forth about what the company is worth in a vacuum. It's also based around the percentage of the company that the investor is targeting. So, and how much money they want to put to work for that matter too. So if I'm an investor and I'm targeting that when I have a 35% ownership stake, and I know that if I put in $1 million on a $5 million if the founders want a $5 million pre-money valuation and they also want a $1 million investment, that doesn't really work for me because I'm going to get a much lower percentage ownership of the company than I'm willing to have. So let's say they keep the $1 million investment, but they decrease the pre-money valuation to $1.8 million, then they get that 35%. The idea being that you can move some of these things around, but if I'm a founder and I want a $5 million pre and you're offering me a $1.8 million pre, that's really not attractive to me. However, if you say, well, okay, we'll keep the $5 million pre-money valuation, but I'm going to invest $2.7 million instead of $1 million, I still get my 35% ownership. Now, these are two extreme cases, but you got to understand there's a balancing act that goes into this of how much money they want, how much money they need, which is a different discussion, and then how much money do I want to put in there as the investor because of my fund economics. So when you're looking at the negotiation with the entrepreneur, think about this in totality. You're not just negotiating one thing. You're also looking at how much money do they actually need right now, and then therefore what is the valuation of that company. These are some simple examples, but we'll move on to the next part here, which is what else affects the valuation of that company. Well, if they have revenue, that's one major aspect of their valuation consideration. If it's a company that is just recently got revenue, I kind of refer to that to as being in the chasm, if you will, of no money whatsoever and making money that's actually consistently recurring. If you're kind of in that chasm between those two extremes, then one way of looking at things could be the run rate of the company, which means that you look at the last 3 months of revenue of that company, or EBITDA or anything else, and you say, let's annualize that. Let's times that by 4, basically, so I get that to a yearly number, and then use that as the basis for looking at multiples against public companies and private companies to get to the valuation of the company. That run rate's a lot more important because if they're ramping up now more aggressively in the last few months, and before that they didn't have a whole lot going on, then that company's valuation could be argued to be that it's more based around what they're executing on now, not the overall last year of execution. And looking at that, it's looking at the multiples is more interesting for mature firms. But you can imagine that if you have a company that's just recently gotten some revenue, it's going to be more of a combination of the two things. It could be looking at how they're performing right now, how we think they might perform in the future, but also what's my percentage ownership that I'm targeting and what's kind of fair to everyone. Which it becomes part of more of the art than the science of the venture capital world because of that negotiation and how that works. Here's some factors, increasing the valuation of the company. Here's some factors decreasing it. I'm not going to get into all the details right now. But looking at the valuation of the company, if you agree with the company that they have a $5 million pre-money valuation, one way that you can effectively lower that pre-money valuation in a way is creating the options, the option pool from the pre-money side. And what this means is that, let's say you have a company that you want to create a 20% option pool in because they have a lot of new hires that they need to get on board. And maybe hire a CEO, et cetera, they could actually create that option pool from their side only, meaning that they had, if you had a one-on-one investment, $1 million pre-money valuation, a $1 million investment, that of that $1 million pre-money investment, only 30% of that would be actually owned by the founders, whereas 20% would be actually in the option pool, and then the rest of the 50% of the company would be owned by the investor. Whereas if you create it from the post-money side, you basically dilute both the investor and the founder and the shareholders existing. And an example that on the bottom of the page here, if you go to Learn VC, there's a more graphical example of how that works. Dividends are really kind of involved, but they're not the kind of dividends that you're used to with public stock. So maybe looking at that example, understanding this in more detail, looking at other resources are important. But in general, you should keep like an 8%, kind of maybe 10%, whatever you want to do there, dividend. And then if the entrepreneur is going to push back a lot on that, that's something you can give up. Again, that's mostly just on the kind of downside protection, because the dividends only become interesting when the company sells for very little money. On the upside, there's just not that much upside to them. That's the conversion into common becomes the really interesting part about the upside for the investor. Now, I mentioned preferred stock, and I've kind of talked about how it's different than our perceptions about preferred stock in a public market sense. There's also different flavors of preferred stock in the startups. It comes back to looking at the liquidation preference, which is basically if I put in $5 million, I get my money back on that $5 million, depending on the multiple that I put that liquidation preference on. So if it's a 1x liquidation, I get $5 million back. If I get a 2x liquidation preference, and I get 2 times 5, which of course is $10 million. That's part of the downside protection side. But also when you look at the convertible versus participating preferred stock, it's fairly interesting because convertible is an or choice. I'm either going to take my liquidation preference and dividend, or I'm going to convert into common. Whereas participating preferred stock is and. I get my liquidation preference and my dividend, and I also get to convert into common stock. And there's a kind of a hybrid of that, which is a cap. So the cap being, let's say I put a cap of 5x cash on cash for an investment cap on my participation. At that point, I can only get my common stock conversion, and I don't get my double dipping, as it's referred to, with the participating preferred feature. Now, at the point of you're looking at the economics of the